You're about to pay a premium for a recurring revenue business. The deck shows tidy growth, low churn, and a shiny ARR multiple. But here's the problem. A lot of what's labeled subscription isn't truly recurring. It's pre-sold credits, channel selling, or renewal optional bundles that vanish right after the deal closes. Overpay once, and you inherit the churn hangover. In the next few minutes, I'll give you 4 quick tests that expose fake subscriptions. One of these tests alone disqualifies 30% of targets I review. If your target fails too, you don't have a subscription business, you have a series of one-off projects wearing a subscription costume. Real recurring revenue is not a label, it's a behavior anchored by contract. Think of it as 4 layers that must stack: contractual obligation, habitual usage, continuous billing and collection, and renewal intent. If any layer is weak, durability collapses. Bookings are promises, ARR is an accounting construct, only retained, collected dollars reflect reality. Your job is to test the conversion from bookings to ARR to cash to renewal. We'll use those 4 layers as our map, and each test we apply will stress one layer to see if the stack holds or cracks under light due diligence. Before we test, know the 5 illusions that inflate ARR: pre-sold credits counted as if they'll always recur, annual bundles with easy opt-out masquerading as locked subscriptions, reseller selling booked as MRR before sell-through, hardware maintenance or implementation revenue bundled as subscription, and promo pricing that doubles on renewal, causing hidden cliffs. Each looks predictable on paper, but all can vanish when the calendar flips. Up next, test 1 will puncture the first illusion by comparing what the contract seems to say with what it actually obligates customers to do. Open the master subscription agreement and score stickiness fast. Do terms auto-renew by default? Is there termination for convenience? What's the notice window, 30, 60, or 90 days? Are there minimum committed seats, usage floors, or ramp schedules? Are price increases defined, and are co-termination rules clear when adding modules? Are discounts contingent on the full term? Green flags, fixed terms, auto-renew, notice greater than or equal to 60 days, minimums, and fees for early downsize. Red flags, month-to-month, termination for convenience, or vague scope. If test 1 is red, the rest hardly matters. Example, a 12-month agreement, billed monthly, sounds robust. But the fine print allows termination anytime with 30 days notice, seats can freely downsize, and overages are credited back. That's not a term, it's optionality. True stickiness requires friction, clear penalties for early downsize, committed minimums, and notice windows that bite. Ask for 3 real signed contracts from top 10 customers and 2 from the long tail. If the headline term conflicts with usage flexibility, count that revenue as at risk, not recurring. Next, verify that customers actually stay. Request a logo and dollar retention cohort table by start month. Look at month 12 and month 24 for each cohort: logo retention, gross dollar retention, before expansion, and net revenue retention, after expansion. Healthy patterns show a gentle slope, not a cliff. If net retention is propped up by a few expansions while the base shrinks, durability is weak. For SMB, you want NRR at or above 100% and GDR near the high 80s or better. For enterprise, thresholds trend higher. To read retention fast, pick a large cohort and trace its revenue over time. Is the curve a slow shelf or a ski slope? Next, separate stability from expansion. Compare gross dollar retention to net. If net is fine but gross is falling, the core is eroding. Finally, check concentration. Do expansions come from a few whales? You want a flat base with diversified add-ons. If cohorts compress early, pipeline must sprint just to stand still. Another sign the ARR label hides transactional reality. ARR that doesn't convert to cash is theater. Ask for billing cadence, auto-pay adoption, dunning process, failed payment rates, refund and credit memo history, and are aging. Look for involuntary churn from payment failures, high aging in 60 to 90 days, and large credit memos reversing revenue. If annual prepaid dominates, confirm renewals aren't discretionary and that revenue recognition matches service delivery. True recurring revenue shows consistent bill collect renew cycles with small slippage, not spikes of credits followed by quiet write-offs. Translate payment failures into annual loss. Suppose 5% of subscriptions fail payment monthly and you recover half through dunning. That's a 2.5% net loss risk each month. Annual involuntary churn 1 to 0.02512, about 26%. If headline churn excludes this, ARR is overstated. Improve assumptions with actual recovery windows and card update rates, but always run the math. Even a 1% monthly net loss is 11% annually. Hidden billing friction can turn a glossy 90% gross retention story into something closer to 70s in cash terms. Finally, test fragility. How much ARR depends on a few customers, one reseller, a single integration, or a narrow use case. Map top 10 customers as a share of ARR, note any with termination for convenience, and flag reseller contracts lacking sell-through commitments. Check usage dependency. If revenue rides on one project, season, or budget source, churn can cluster. Durable subscriptions spread risk, no customer over 10 to 15%, channels with real end-user retention, and usage tied to ongoing workflows, not one-off launches. Channel revenue can look stable until you ask the right question. Did end customers actually activate and renew? Request reseller sell-through data and end customer cohort retention, not just purchase orders. Insist on rights to contact top end customers or at least anonymized usage data. If the channel can return inventory, defer launches, or swap SKUs, your ARR is conditional. Real partner ARR shows steady sell-through, end-user retention above 90% gross dollars, and aligned incentives, renewal revenue shared, not just first-year commission. Do a quick ARR cleanup. Example, claimed ARR $20 million. Step 1, remove non-recurring, pro services, hardware maintenance, and one-time bundles, say $3 million. Step 2, adjust channel selling, strip $2 million that hasn't sold through. Step 3, apply billing friction, assume 2% net monthly payment loss corrected for 12 months, about 21% annual, apply against remaining susceptible SMB portion, say half of $15 million, $7.5 million times 21%, $1.6 million risk. Clean ARR $20 million, $3 million, $2 million, $1.6 million equals $13.4 million. Price the business off the clean number, not the headline. Ask for 5 items up front. 1. An MRR bridge by source for the last 12 months, new, expansion, contraction, churn, with definitions. 2. Cohort tables for logo, GDR, and NRR through month 24. 3. Top 20 customers with contract terms, notice, auto-renew, termination, minimums. 4. Billing and collections KPIs, auto-pay percent, failed payments, recovery, refunds, credit memos, are aging. 5. Channel sell-through and end-user activation. Most sellers who truly have recurring revenue can produce this in hours. Resistance itself is a signal. If tests reveal fragility, don't just walk, reprice and restructure. Tie earn-outs to net revenue retention, not top-line ARR. Use holdbacks against our over 60 days or against sell-through confirmations. Require representations on termination rights and discount conditions. Consider step-down pricing if promo cliffs are steep. Durable subscriptions earn high multiples, optional revenue earns contingent payouts. Structure turns uncertainty into alignment. If they believe the ARR is real, they'll agree to get paid when it proves out. Beta CRM claims $18 million ARR. Test 1, contract stickiness, mini 12-month terms, but 30-day termination, no minimum seats. Red. Test 2, cohorts, logo retention 86% at month 12, GDR 84%, NRR 101% driven by 2 large expansions. Yellow to red. Test 3, billing, 4% monthly failures, 60% recovery, net 1.6% monthly 18% annual involuntary churn. Yellow. Test 4, concentration, top customer 17%, a reseller at 22% with weak sell-through data. Red. Normalize, minus $2.5 million non-recurring, minus $1.8 million selling, minus $1.1 million billing risk clean ARR $12.6 million. Value off $12.6 million with earn-outs on NRR. Real recurring revenue survives 4 questions. Is the contract sticky? Do cohorts stay and grow? Do bills get paid with minimal slippage? Is revenue diversified and independent of a few actors? Pass all 4, and the multiple can be justified. Fail to and reclassify, reprice, or walk. Use the checklist to collect evidence in hours, not weeks, then normalize ARR and structure to risk. Buyers who consistently run these tests don't just avoid overpaying, they win better companies at fair prices and sleep well after signing.